All righty. Yeah, right. No, good evening, everybody. How y'all doing? I'm going to see if anybody in the back is listening. Ooh, yes. Hands are waving. Thank you. Fantastic. Good evening, everybody. Welcome to another in the series of what we call a Real Estate Connection. My company, Perkins Co, started this how many years ago, Mr. Kahlberg? 6, 8? A few. And we have been putting on these real estate connections 2 or 3 times a year, primarily focused on timely topics that matter to the real estate industry. So it's a chance to not only get updates on current events, but also a chance to get to know each other, spend some time together, mix and mingle a little bit, and just share the knowledge that we all have. And I know this is a giving community, and you guys do share a lot, so we love that, and we love being a part of this. And it's also a chance for my firm, particularly our real estate team, to show off a little bit. We are the preeminent real estate team in the area, we think in the region, wickedly smart, and a group of about 24 folks, Tim, I think, involved in our real estate practice. Those of you who are part of the real estate team for Perkins, just raise your hands so folks know who you are. Yeah. Can we do the shout? We'll be worried. That's it. Yeah, the wave, the shout. We must have. I mean, accountants, we do need to come up with some kind of a yell. But the best part about tonight is we have a panel, and Tim's going to present, and then we also have a panel, but one of our panelists was flying in literally today from Chicago, and he texted me this morning at 10:30. He said, I think I made the flight, and I should be there by 4:15. So we know how Portland goes, but he's arrived. So we have a full roster today, so we're super excited about that. How about a show of hands for those who are first-time visitors here? All right, awesome. Welcome. I hope it's not your last. How many people have been here more than 3 or 4 times and been enjoying the series? Thank you. Okay, and so we also encourage you to send us topics that you have. That matters the most to us, that we're addressing the needs that all of you have. So please don't hesitate to ask me or Tim or any of the Perkins people. Let them know if you have something you would like us to bring to the group, and we will do so. So the format is we're going to have Tim Kahlberg is going to present initially, and then following that we will have our panel, and then we'll have time for Q&A at the end, and then more social time as well. So as he often does, Mr. Kahlberg has a fascinating way of presenting very scintillating information related to taxes. And he's also going to talk, who knows about the Opportunity Zone? Anybody? Yeah, right? That's pretty timely stuff right now, right? There's a lot going on. Very interesting to see how that'll all develop. So please welcome Mr. Tim Kahlberg, who will give us a tax update and then share a little bit more about ozone.
Thank you, Dave. Thank you all for coming today. In the next 15 minutes or so, I'm going to try to fast forward through as much information as I can on opportunity zones. I know many of you probably have a good grounding in them, so I'm going to give kind of a brief background as far as where they started and what they mean, and then finish up with a little more details, focusing primarily on the additional guidance that we received from the IRS on October 19th. So I wasn't looking. How many people have heard or know about opportunity zones? Quite a few. So, all right, so I'll skip through fairly quickly most of the basics. And then time permitting at the back end, I'll just highlight a few items and tidbits for you to think about as we're approaching year end, especially in light of the Tax Reform Act. So ozones were brought in as a way to create economic stimulus and development in challenging areas, depressed areas throughout the United States and its territories. What they did is they said, well, how are we going to pay for this? So they created some tax benefits and some incentives to do that. There's 3 primary tax incentives that they did to stimulate investment in these communities. First of all, you get a deferral of taxes. That's key. It's deferral, not elimination or exclusion. It's deferral. So keep that in mind. You can get a deferral of capital gains for up to 12/31/2026. Then the question was, when this rule first came out, what is gains? The original law said any gain. Nobody knew what that meant. Everybody thought it meant that they intended it to be capital gain, but it wasn't really clear. So people wondered, well, can I exclude inventory, ordinary gain, that kind of stuff? Well, the recent guidance that came out in October, clarified that it's capital gains. The thing, though, that it also helped clarify, at least in our opinion, is it said any gain treated as a capital gain in your personal tax return. And I know there's some tax attorneys out here and stuff, so you guys are well versed in this, so you can correct me when I misspeak on any of this stuff. But what that to me means, and what our team thinks, is that 1231 gains on the sale of real estate or unrecaptured 1250 on your depreciation recapture, those should qualify so long as they wind up as a capital gain on your individual return. Now comes even better news. If you hold your investment, if you elect to defer your gain and hold your investment for at least 5 years in a qualified opportunity fund, you get to exclude essentially 10% of the gain that you rolled into the fund. If you held it for 7 years, then you get to exclude another 5%, combined total of 15%. So that's the good news. The last piece of good news in terms of the tax incentives is that if you hold your investment in the qualified opportunity fund for at least 10 years and then dispose of it, you get to exclude your appreciation on that investment in the qualified opportunity fund. So those are the primary tax incentives that you get for investing in qualified opportunity funds. Now let's take a look at some of the requirements, first on the taxpayer side, and then we'll turn to the fund side. On the taxpayer side, the requirements is that you have, as a taxpayer, if you recognize a capital gain, you have 180 days from the time you realize that gain to essentially invest that gain in a qualified opportunity fund. And then you can exclude that currently and defer it until either 12/31/2026 or earlier if you dispose of your investment in the qualified investment fund. It's a cash-only type investment. You only need to invest the amount of the capital gain, and it's not an all-or-nothing concept. So say you had $1 million investment that you sold, you had $500,000 of basis in it, so therefore you have $500,000 of gain. Well, you can invest anywhere from $0 to $500,000 in a qualified opportunity fund and exclude that compensatory amount of gain on your personal tax return or at the entity level. That was another question that we had was, who can make this election? Who does make this election? Is it, if you're in a tiered environment, pass-through entities, S-corps, partnerships, REITs, RICs, those types of things, who actually makes the election? Well, the election can be made at any level. That was the additional guidance that came out in October. It allows for, say you have an investment in a partnership realizes the gain. The partnership could make the election to roll over the entire gain. If it does it, then it doesn't pass that out on your K-1 and it stays inside the partnership. However, the partnership can say, no, we're not going to make that election, and it can basically pass through the gain to all of its partners, proportionate and pursuant to its operating agreement or partnership agreement, if it's a limited liability company. And then each and every partner or member can then determine whether or not they want to do it at their level. So that's true whether it's partnerships or S-corps or whatever. That was favorable, welcome news that we got from the IRS as part of this additional guidance, because that was one of the huge questions we had. And note that this is a little different from the 1031 world. In the 1031 world, you've got to roll over all of your investment, including your basis, whereas here, going back to my earlier example, you could keep $500,000 back and reinvest it in something else and only have to reinvest the $500,000 into a qualified opportunity fund to be able to exclude it. One thing to keep in mind here is that you can't manufacture these capital gains to take advantage of these rules. The IRS is not that stupid, so they thought about this, and they put in some related party preclusions. And in this case, so what you can't do is you can't sell a capital gain asset to a related party to you and then generate a capital gain to either step up your basis and reinvest or whatever to diversify your portfolio. So this has to be to an unrelated party. The one thing that they did do here, which I'm not going to go into for time reasons, is they reduced the hurdle. Normally, a lot of the related party rules are at 50% test or above. In this case, they dropped them down to 20%. The other thing that I wanted to highlight is back to it's a deferral. You can exclude, if you meet the test, up to 15% of your gain, but you're still going to be paying the income tax on that gain, at least 85% of it, no later than your year that includes December 31, 2026. So that means that if you deploy all of your cash into one of these qualified opportunity funds, you need to figure out a way to ensure that you're going to have the cash to pay the tax come 2026, April of 2027, because I doubt you're going to be able to look to the Qualified Opportunity Fund to get that cash back to you. Now let's turn our attention to the fund side and some of the things that it has to do to essentially qualify so that investors, taxpayers can invest into the fund. First of all, it has to be taxed as either a corporation or a partnership. One of the questions that we had was, do LLCs qualify? The additional guidance does clarify LLCs do qualify, whether it's a multi-member or you could have a single member or entity that elects to be taxed as a corporation. So that all qualifies. It also has to be formed for the express purpose of investing in essentially qualified opportunity zone assets, stock, partnership interest, or property. And you can see up here on the screen what those are and what they qualify. There's to stay or to qualify as a qualified opportunity fund, there's an asset test that you have to meet. And what that asset test is, you look at your applicable financial statements, and the testing dates are, in your first year, it's 6 months after your date of formation, and then the end of your fiscal year, calendar year end typically for most of these. And then annually, it would be every 6 and 12 months. So at each one of these testing dates, you need to have at least 90% of your assets invested in these qualifying types of items that are shown here on the screen. What happens if you don't? Well, there's two things that could happen. One that could happen is you could actually wind up eventually disqualifying your fund, which would be bad answer and bad results for all of your investors. But the more likely scenario, it seems, in looking at some of the information published, is that essentially the entity gets a penalty that is based on the underpayment of interest charges for the period, the number of months in which it's out of compliance. So it may not disqualify your entire fund. You just may have to pay this additional interest/penalty tax. Another question that we had, a couple of questions that we had and still are not answered relative to the additional guidance are, money comes into the fund. How long does the fund have to deploy the cash? And what happens and how do you do that 90% asset test that I was just talking about in terms of with that cash? Well, this additional guidance at least gave us some favorable news in that it gave us a reprieve for a safe harbor for basically reasonable working capital. And what they defined as reasonable working capital was an amount that when the cash comes into the fund, if you have a written plan in place, if the fund, has a written plan in place to spend that money, it also has a designation onto how or the types of assets it is going to spend that money on. And it has a written schedule as to when that money is going to be spent. So think construction budget here, that type of thing should meet this type of test. So it's easier to me in a real estate sense than it maybe is in a trade or business type sense. And then you have to have completely consumed that cash within 31 months from the date that it comes into the fund. So if you meet all of those requirements, and on top of that, your consumption is consistent with what you said you were going to do, then what that means is that cash that's sitting inside your fund is effectively not treated as a bad asset for purposes of that 90% test. In other words, you can treat it as a good asset as if it is one of those types of assets. One other thing I want to make a note of is on the substantially improved. So opportunity zones, again, were meant to invest in, develop, or start new businesses within distressed areas. Land is never new. Somebody's always owned that before. An existing building on land is never new. So the IRS, in its additional guidance, came out with some favorable information where they said, when you're looking to substantially improve, and the test for substantial improvement is you have to, over a 30-month period after acquisition of an asset that's already existing, you have to at least more than double your basis in that asset. So when you say you bought a piece of property for $1 million, $400,000 was allocated to an existing building on it, $600,000 was land. Well, the question was, do we have to spend $1,001 to substantially improve that? And nobody really knew until this additional guidance, which came out favorable and said, no, you do not have to substantially improve the land, it's just the building. So going back to my example, you'd only have to spend $400,001 to make it work to meet this test. Mixed funds are allowed. What does a mixed fund mean? A mixed fund means that if you as an investor come into a deal, or the fund receives money that is not all just deferred capital gains. So say you invest $500,000 of capital gains and $500,000 of additional cash because you're a nice person, you believe in the policies, you believe in the fund, you believe in the sponsor, you want to do the right thing, you think it's a good investment even though maybe you sacrifice some additional things. What does that mean? Well, what tax law does is it basically treats you as having two separate investments. You have one investment that's the qualified investment, that's the $500,000 gain rolled in. You have a second investment that's the $500,000 that's additional cash that you put in. The additional cash is just like any other real estate deal that you have in today's environment. You don't get any of these special provisions. You don't get the gain deferral. You don't get the appreciation on it and the exclusion of that at 10 plus years. It's only for the $500,000 gain that's rolled in here. So that's what it means by a mixed fund. The other thing that this additional guidance clarified for us is that it says that debt inside of these funds doesn't create an additional mixed use investment. So what do I mean by that? What I mean by that is that in my example, if you had $500,000, it's all gain that you reinvested, and you didn't invest anything else, and then the partnership went out, borrowed money, the fund did, and then used that to develop a property, and say you got allocated $150,000 of that debt, that $150,000 allocation doesn't create a mixed use or a mixed fund investment for you. So you're still, all of your investment is still qualifies for these opportunity zone tax incentives. How do you identify yourself as a qualified opportunity fund? Well, good news here is you're on your own to self-certify that you meet the tests. You do that by filing Form 8996. There's a draft of that's out, actually right here. The draft of that form does two things. It goes through that asset testing that I was discussing. It also gives some information about the first year of the fund and when you elect to start your clock and some other mechanics. And then page 2, which is embedded here, is for calculating that penalty that I was talking about, that interest undercharge. In terms of where are these opportunity zones located, I'm sure probably many of you have already seen this and know this. This is a map that kind of shows the state of Oregon. The blue, obviously, is where they're at. And we drill a little deeper, and you got the Portland Metro and surrounding area here, and then the downtown core area. So as you can see, it's a good thing that there's a delay in our census tracts so that we have the ability to develop all of these depressed areas in the city of Portland. And for our guests that are north of the border or our guests south of the border that want to develop north of the border, similar story. There's some pretty amazing opportunities, no pun intended, here in developing. So that's all I have on opportunity zones. How am I doing on time? I will be around as well as the rest of our team to answer questions after the fact. We want to be respectful of our main speakers in the panel and make sure that they answer all their questions. One question I have for the panel is what do these incentives do in terms of the issues that you're going to be talking about? And how do they play into the overall environment? So I look forward to them sharing and highlighting with us with that. With that, I want to shift gears real briefly. I want to just hit a few high points of the tax reform. Believe it or not, we're getting close to the end of 2018. Good news is we have new tax law. Bad news is we don't have a hell of a lot of guidance that's come out since they passed this. The guidance that we've got to date is on the 199A pass-through deduction, and as well as the guidance on the opportunity zones. There's been some guidance on the international tax arena, but for a lot of the other provisions, we're still hoping, waiting for guidance, but we may not get it, and we may just have to make some educated guesses. Or even for those areas that we do have guidance, we may still have to make some educated guesses. The 199A deduction is the big one. Remember, this is the one that allows you for pass-through entities to essentially take a deduction for up to 20% of your qualified business income. We've talked a lot about that before. I think the one update that's most pertinent here is that the additional guidance was actually favorable, more favorable than what we thought we might get from the IRS in terms of the real estate industry, in that real estate brokers, real estate agents, developers, property managers, all of that is good income, should qualify for this deduction. What doesn't qualify is for those of you that are going to go out and set up these qualified opportunity funds and take an asset management or an investment management fee off of those funds, that probably doesn't qualify for this. So just something to keep in mind. Not that that's a bad thing, it's just that's what it is. The other thing that we've learned from this additional guidance is that it's the Full Employment Act for tax accountants, such as myself and tax attorneys, and probably malpractice attorneys once we get done and file all this stuff. So what we're going to have to do when we prepare your partnership tax returns is we're going to have to look at it. We're going to have to analyze what's going on inside that business And we're going to have to say, do you have one trader business? Do you have more than one trader business? And here, if I want to go even more granular, some of the questions become, is residential real estate a different trader business than commercial? And if I get into commercial, is industrial different from retail? From commercial, true commercial office buildings? There's no guidance on that. So if we don't get it, we're going to have to make an educated guess and file. We've had some discussions internally, and I'm curious to hear what some other people think, but there's part of us that think, hey, it's rental real estate. No matter how you slice it and dice it, that's your trader business. So that should be your trader business as opposed to get that granular. But say we have to get that granular, then for each trader business of a partnership, those 3 items that are highlighted there on the bottom, we're going to have to report for each trader business. We're going to have to say, and there's a 4th thing that I didn't put up here, but first of all, is that trader business a specified service trader business, which is bad. If it's not a specified trader business, then it's good. So then the second question, or the other items that we need to disclose for each one of those is the amount of W-2 wages, and this is the cash W-2 wages, not the accrual basis wages that are deducted if you're an accrual basis entity. What is the UBIA, which is the unadjusted basis in assets, which is a totally different calculation. You basically look to your historic cost, but there's adjustments depending upon if it's 1031 property that you're looking at, if it's basis adjustments from death or sales of partnership interests or those. So there's some adjustments and modifications, and it's not the net depreciated basis, it's the original historical cost basis there. And then lastly, the amount of net income or net loss associated with that for QBI purposes. So that's going to take us a little bit of work, and you're going to get asked a lot more questions from your CPAs when they're preparing your returns this year. If you don't, I'd be cautious. Quickly on depreciation, I think the 2 things to highlight here, we still don't have a technical correction, qualified improvement property, leasehold improvements, that kind of stuff. Unfortunately, it's still 39-year property, straight line, no bonus depreciation. Sad face, sad face, sad face, sad face. But the good news is you can go out and buy a pre-existing asset, and to the extent you can do like a cost segregation study or whatever, and carve property off into either a 5, 7, or 15-year land improvements, and you can get 100% expensing of that in the year of acquisition. So that's kind of the big. It's got to be new to you, so you can't buy it from a related party. This slide is just highlighting a few other items. We've talked about most of these. Unfortunately, we don't have a lot of guidance on these. The one thing, couple of things to highlight, and I know we've talked about, and maybe people already knew this in the audience. I did not know this till this morning, but I knew the city of Portland was actually thinking about bumping up their rates 0.4%, but I did confirm with them that it is actually in place. It is effective for 2018, so your City of Portland rate is now 2.6%. So the combined city and county is now 4.05%. So keep that in mind. The other thing, I know we've talked a lot about this in prior events and in blogs and newsletters, the partnership audit rules. Everybody's kind of stuck their head in their sand that nobody's really, other than in new entities and new deals, nobody's really wanted to address these or deal with these, or at least it's been slow to happen. But our recommendation is you go and you sit down and you talk to your tax attorneys or your corporate attorneys and counsel and seriously consider updating your agreements. especially if it's going to be in existence for a while. Why do you want to do that? 2 reasons. Number one, the concept of tax matters partners is gone. It's now a partnership representative. Partnership representative has no obligation to inform all of the partners that there's an IRS audit going on and has unlimited power in making decisions pursuant to that audit. So that's one compelling reason to do it. The second compelling reason to do it is unless in very limited circumstances you are a qualifying partnership to elect out of these rules, they're mandatory. And what happens is that the IRS can assess income tax at the highest rate on the partnership. So essentially what has happened under the old partnership audit regime, TEFRA, the onus was most on the IRS to track down, calculate all adjustments, that kind of stuff. Well, the IRS basically and Congress flipped this, and now they've pushed that onus onto onto the partnership and the partnership's representatives. Now, you can make an election to push out that tax liability, but there's a cost associated with that. And also, this is going to be a big issue for due diligence and partners coming in and leaving, because there's a difference between assessment and the year under audit and the assessment year for when the audit is finally settled. And if you have partners coming and going in between those two, depending upon what your agreement says, it could control who's liable for that tax. So you could come into a partnership that's being audited for a year before you were ever a partner and potentially pay income tax through the partnership. So those are some compelling reasons why we would like to see you go out and update those old agreements. On the personal side, I think most people are aware of those. I'm not going to cover those. The last item I will leave you with is your new postcard 1040. We finally have a draft of that. This is what page 1 and page 2 of your 1040 looks like, folks. This is it. I know you can't read it, but the item shown in red is that qualified business income deduction that I was talking about earlier, that 199A deduction. That's where it's going to go. And then what they did is they basically took a lot of the stuff off of page 1 and 2 of your 1040 and moved it into schedules. So there's a lot of changes out there. And with that, I'm done. Thank you.
Okay, so I guess the takeaway for me is that if you don't understand any of this and your CPA is not asking these questions, you should give us a call. I'm the head of business development, so it's my job to make sure that that you're talking to us. Thank you, Tim. That was great. And you and the team will be around afterwards as needed. So I do have one question about, Mr. Kahlberg, I do have one question about the fact that a golf course is a vice. Doesn't qualify? What? I think my wife's been saying that for a long, long time. How many of you are struggling with that concept?
They just don't have a strong enough lobby.
That's it. Yeah, you're right. You're right. Okay. So as if the opportunity zones and tax updates aren't scintillating and provocative enough for everybody, we're going to tackle and discuss the future of Portland as it relates to housing and urban development. And I think that's why many of you are here as well. So the questions, the big questions is, are we heading toward Seattle and San Francisco? Is this really what we want? Is it too late? And what are the factors that will influence this over the next 10 to 20 years? And so here to help us address these questions and more are our two panelists, Tim O'Brien and Mike Kinsella, if you guys want to come up. So Mike is the executive director of Up for Growth National Coalition. Hi, Mike. And Tim. Mike's organization brings together affordable housing and social justice advocates, housing producers, major employers, environmental groups, urbanists, and transit associations, all to address our nationwide housing shortage. Sounds about as challenging as solving the healthcare crisis or maybe PERS. It's a good thing you're a young guy if you can solve these, Mike. Outside of his role with Up for Growth, Mike leads the public policy and government affairs arms of Holland Partner Group. And Tim O'Brien, no stranger, I'm sure, to many of you. He's been a leader in the Portland commercial and multifamily real estate community for almost 20 years. After working with a national real estate firm, Tim founded HFO Investment Real Estate and grew it to become a leader in the multifamily brokerage before initiating a buyout to focus on ground-up development and investment. Tim has personally invested in and syndicated partnerships totaling over $175 million and nearly 1,000 apartments in Oregon and Southwest Washington. So how about a hand for Mike and Tim before they get started? And our plan is that I have a series of questions that we've collaborated on to put together to try to give you some insight and they're both of their points of views. But we also welcome your questions too. So if as we're going along you have a burning question, just raise your hand and we're going to kind of go through a series of topics. So if you have a question relevant to what we're talking about, raise your hand at that point and we'll jump in with you. If not, we'll grab it at the end and I'm sure the gentleman will stay afterwards to answer a few questions as well. So great to have both of you guys here. Thank you. And Mike made, I've talked to Mike in the last week or so for several times. I think he was in Chicago today. It seems like you're in LA before that, Washington, D.C. before that. Is that correct? You've been traveling like a crazy man. Yeah.
That's right. It's part of running a national coalition. So
wonderful. Well, we look forward to hearing more about that, and I'm sure it'll all weave together. So, Mike, I'm going to fire the first question at you, which is we do hear a lot about the growing housing crisis, which is not unique in Portland or Seattle or San Francisco or any of the cities on the West Coast. So, in fact, nearly every part of the country is dealing with that. And rents are rising faster than incomes are. And so what is your analysis of that phenomenon?
Yeah, thanks, David. You know, from our perspective, we really have a crisis, we like to call it, of a lack of housing availability and affordability. And the lack of availability really drives the other crisis, which is a lack of affordability. And so we have, many growing markets throughout the U.S., from, Portland to San Francisco to Seattle and on east to, Boston, New York. You have a case of demand really just outstripping available supply. But it's not just, rapidly growing cities. I mean, we're even seeing housing shortages in places like Arizona and Utah. And so, as we've gone into the numbers and looked at the data around household formation versus housing unit production, we're really seeing the U.S. as a whole underproduced to the tune of 7.3 million units over a 15-year period. And we're digging ourselves deeper into a hole. By our estimates, we're digging ourselves into a hole nationally to the tune of about 500,000 units per year. And so our estimate is that by the end of the next decade, we need to build another 12 million units over and above what we're currently on pace to build, just to fill that backlog of needed housing and also keep up with new demand. And so, Portland is an example of a place where we're at this tipping point. We've recently seen a significant increase in housing costs from a purchase perspective as well as from a rental perspective. I was just checking the numbers. Unit affordability over time. We have an application on our website you can actually go to and look at any city around the country, any market, any state. And we've gone in Portland from the average one-bedroom being affordable to a household earning about 60% of the area median income to close to 100% of area median income today. So we've seen a tremendous increase, or I should say deterioration in terms of affordability, just right here in Oregon. And all told, we're about 150,000 units short from 2000 to 2015 here in Oregon. And based on the state's economist figures, we're on track to underbuild to the tune of another 125,000 units. So this sort of relationship holds. if we want to have a balanced housing market and we don't want to become the next San Francisco or even the next Seattle, we really need to focus on changing the policy environment where the market can build really what the market is demanding and significantly increase housing production.
And Tim, I imagine you see that and you corroborate with Mike's assessment. But then, with the need as great as it is, why aren't developers just jumping on this and moving quickly to take advantage of it? What's going on there?
Yeah, I think you're seeing that has occurred on this last cycle. We've now actually built up to, I think, an equalization of supply and demand. So we're actually seeing that equally. Yeah, I'm not hearing it that well from here, but we're seeing that equalization happen right now. We're in lease up on 3 buildings. We're fighting it out for those tenants and the rents and giving concessions and in some cases even lowering rent. So I think that has occurred. So yeah, what you're really talking about is the future. What do we see the pipeline as today, at least is how I perceive the question, and why are we not going to be building more? I've made the statement a couple times in public that we're not really seeking land right now in the city of Portland. We can't afford to do a deal here at this point. IZ, was talked about this morning for those of you that went to the NAOP event and kind of heard a little bit more about that. But that's kind of the straw that broke the camel's back. That's not the only thing. Hard costs has been a huge inflation driver for these projects and not making them pencil. Interest rates have been another one. But hard costs, I use the example. Actually, I just got an email from one of my friends. Patrick, are you here, by the way? Oh, there you are. So Pat, can I quote this? So Patrick Barry was very kind. He sent me an email prior to this. He had done a survey of developers like myself about cost inflation. And it was very much in line with what we experienced. So the first project we did as Urban Asset was Lower Burnside Lofts. We bid that project out in 2014, I think it was $149 a foot. 5/1 podium deal, 63 units. That same project today would probably cost in the neighborhood of $230 a foot. And this was the other 3 examples that Patrick had quoted. He didn't name the developers, but we're pretty much in line. You're seeing over 10% inflation in hard cost. Of course, this year we just saw the 10-year just went flying up here in the last 3-4 months. Cost of capital is a big driver for feasibility. And then you combine that with inclusionary zoning and the city basically putting the burden of those reduced rents on the project with not enough offsets. You've just got this perfect storm of why we're not building those units.
So if the land use codes, though, too, are changing and encouraging development outside the city, why aren't we seeing more of that? Where is that going?
I think you will. You're seeing some more of that. We're doing a couple of projects with a good partner out in Gresham, some workforce housing deals, and the only reason those are working is because you've got a different building construction style that costs less to build. If you're going to build a podium deal in downtown Portland, it's not going to cost you any less to build it out in Gresham or Tigard or anywhere else. So you have rents that are a lot less. So it's development performers are pretty simple if I break it down to, kind of Joe Weston style, back a napkin, right? It's like you've got the costs on one side and you've got the income on the other. And when one gets out of balance, deals don't happen, right? And this is how I try to explain it to our politicians, right? When Mike and I were on the Oregon Smart Growth, we're still on the Oregon Smart Growth Board together. Mike was leading that organization and they still don't get it sometimes, which is a little frustrating. It's like, listen, guys, it's like macroeconomics, supply and demand. This impacts, and then it's just cost and income, right? So when you do something like IZ, you're impacting the income side of that equation, right? You're giving a little reduction on the cost side, but it's not enough of an offset. I like to say if you took $1 away, they might be given 50 cents back or 40 cents back. They need to be given about 90 cents to 95 cents back. don't put the burden on the project.
And I would add, that's a great perspective on a single project standpoint, right? But the other surprising outcome in this cycle is that, we're seeing housing shortages in markets like Utah and Arizona, not exactly, epicenters of NIMBYism or, significant layering of regulatory burdens or, anti-development code. And so why is that? Well, I think to some degree we've sort of, we're playing a game of musical chairs and we don't have anywhere to sit down as it relates to infrastructure financing. And so infrastructure financing post-global financial crisis has increased tremendously. And there's a researcher out of the Midwest, Chuck Marone, does a blog called Strong Towns, and he talks a lot about this growth Ponzi scheme. So this notion that, the way that American cities have been expanding is by annexation or extending infrastructure and charging systems development charges or impact fees to the next incremental unit, which, as Tim points out, is really sort of, leading to suboptimal outcomes in terms of our leverage of infill sites, urban land development opportunities. But it also, has gotten to the point where there is insufficient money that jurisdictions are able to raise vis-a-vis impact fees or system development charges to expand that infrastructure. So we're actually seeing a constraint on the flip side, which is, to your question, Dave, out on the fringes of these growing regions, why aren't we just seeing more housing production occur there? Well, to finance the infrastructure that is necessary to serve those new homes, the money's just not there. And so that, really is the answer to why do we have a housing shortage in Arizona. And I think in an Oregon context, of course, we have urban growth boundaries, and we're unable to, expand except for leveraging infrastructure in places like Gresham, which actually isn't a bad idea, but you need the economics to be there in order to pencil the type of density that planners would ideally like to see. So what's the solution? So our organization is very focused on several concepts. One is, creating more certainty and shortening the timeline to produce, because time is money, and time, value of money. You have a carry cost on your interest. You have, certainty. Your equity costs more if money is outstanding longer and longer. So, that's one idea. And the other idea is simply, we've spent a lot of time figuring out policies, in the abstract or in different bureaus of the city that increase costs to housing production. Let's think about how we take a global approach to decreasing cost to housing production. And what are the new mechanisms from a statewide perspective where the state can, get at sort of resolving this infrastructure financing challenge, but also bring about, superior economic and fiscal outcomes for the state as well.
One thing, we talked about having a large employer from Portland present today. We're not able to secure that company, but I do know you guys have an opinion. I'm going to throw that back at you just to get your perspective on it, which is, the attractiveness of working in downtown, the appeal of downtown, but then you got all the employers are fighting to keep and retain and attract employees, right? And so housing cost is a factor there. So what are you seeing employers recognize that and deal with that? And do you have a point of view about how the employers, the downtown and Portland employers, are able to deal with the shifting cost and the expense of housing?
Yeah, I mean, housing affordability is a talent issue, right? So any office developer, any office owner, looks at sort of the Cushman, occupier, the Collier's occupier survey. And top of the list, year after year over the past several years, has been talent. Well, what drives talent, or what makes talent more available, is quality of life, affordability of housing. And so I believe that that housing affordability from a major employment standpoint is going to be the workforce development policy challenge of the next decade. We're already seeing this down in Southern California. We're seeing it in Seattle. The Seattle Chamber and the Los Angeles Chamber of Commerce just joined the Up for Growth coalition to invest in policy solutions to our housing underproduction or housing shortage. And we see also states like Vermont that are literally developing economic development strategies for their states, which is based on poaching tech talent from the Bay Area by saying, move here, you can telecom commute, we'll cut you a check for $2,000 to move to Vermont and live. And so, that's a real sort of risk from an urbanist perspective. Anybody who believes in, cities and the power of cities to generate innovation and talent. But from on the ground, we were just talking to Cedars-Sinai down in Los Angeles, and they were saying, our employees, a lot of our employees are commuting more than 2 hours back and forth to the work site, to the hospital. And, you need your healthcare employees, sharp and ready to go if they're going to perform surgery, or if they're going to, and so, this is an issue that more and more employers are talking about. And it's important, as you all know, to get attention on political issues. You talked about, you need more than just one sector, one industry at the table. And I think we're starting to see that.
So Tim, if the lack of available housing is a policy-made problem, then what are some of the possible solutions from a policy standpoint?
Well, I'll dovetail off of Mike. Costs. I mean, again, they're passing these costs, these SDCs, and we've seen the parks just, go through the roof. We used to, again, kind of using that kind of our first project example from 2014 to today, we used to budget, $14,500 per unit in permit SDC costs, and that number is now $22,000 for a similar size project. So, they need to, if they really want the housing, if they realize how important it is, they've got to be a partner in helping create that and make the performance work. And to make the performance work, unfortunately, they have to understand the performance, right? They need to understand that cost and income need to balance. I mean, again, it kind of goes back to that simplicity, right? Again, just like, hey, anytime you decide to raise money for parks and you put it on a new project, you're increasing the cost. So we already know that that new unit is going to be the most expensive unit in the city, right? So it's important, and those costs are just going to continue to climb. So the more we can get in the pipeline today, the more we can kind of keep this supply-demand equilibrium in place that we've got. And we're not. I mean, kind of forecasting forward, jumping a little ahead, but I think 18, 24 months from now, we're going to see rents are just going to start going like this again, because supply is going to be done once we build through this cycle, and people are still moving to Portland. We had, 30,000 people move here this last year, 35,000 people last year. They need a place to live.
Do you want to tackle any of that?
Yeah, and just to add on to your point, I mean, I would say that the city of Portland did a really, in a way, did a really smart thing in 2016 to kickstart supply in the city of Portland, which is discuss creating an inclusionary housing program. Since 2016, we saw a rush of building permit applications to the permit desk. I think 2017, 2018 are some of the highest years of production on record. Of course, now to Tim's point, we're seeing a significant drop-off because post February 1st, 2017, we saw about an 80% decrease in building permit applications come into the city. So, as what happened as a result of that, from a policy perspective, we've seen rents moderate. We've seen Class A rents flatten, even in some cases drop when you take in concessions into account. And so that's good for affordability. So are there better ways to get at, increasing supply than, spook the market into rushing to a permit desk? I think there are, and I think those are the policies we should be focused on both as a city and a state.
I also think, too, I know the governor's office has been working on actually building up the trades for construction and actually providing grants and training and really helping that industry become more robust. I think that's important. I know they've been working on that for at least a year because we do need more workers in the construction side, especially now you look at, you're going to see a fall off in the amount of housing projects getting built, but we just passed a $340 million bond measure, and fortunately we passed a constitutional amendment to go with it. So now we've got some good opportunities, I think, to leverage that money into some public-private partnerships. So I think there's some policy stuff there. And I think it's just really helping to educate our, both at the state and the local level. I think the state, you're going to see this coming year in 2019 and really take a leadership role in housing. I mean, I know the Speaker Kotek is definitely going to be putting forth a housing bill and really trying to I guess, be that incentive from the state standpoint. And in some cases, they're going to need to craft policy that doesn't leave room for the local municipalities to kind of skirt around it. You know, I know we've got rent control coming up here, 2019. It's going to be a hot topic. I mean, Speaker Kotek's made it clear it's going to be a housing push, but it's also going to be a renter protection push. And so, trying to help define the margins of that and what does that mean. So there's a lot coming up here in 2019 that's pretty critical that could really have either a very positive or a very cooling effect on housing.
Do you see it the same way? Mike?
Absolutely. Yeah, National Multifamily Housing Council is a trade group that represents multifamily developers around the country. And they partnered with the National Association of Home Builders to look at regulatory burdens on new production, new housing production. The national average, the percentage of regulatory cost on total development cost nationwide is 34%. You know, and how much of that is self-induced, and how much of that relates to the layering of SDC fees, whether it's parks or whether it's, you know, uncertainty, extensions, and sort of the time of permit approval beyond, you know, what is normal or average around the country, and how much of that is actually leverageable, or how much of that is self-determined by the city. We have a long history of local control in Oregon and across the country as far as land use and housing decisions. Education and I think housing are the two big policy pillars when statewide elected officials talk about what the state is responsible for, what the state can do. But we haven't relegated education to the localities like we've relegated housing decisions to, right? So if you think about the ability to zone for multifamily, that's a local decision. Resident, occupancy requirements, that's a local decision. With education, we don't say, credentialing your teachers is a local decision. We don't say that a certain number. Your locality and you want to run schools for 30 days a year, and that's you would look at somebody like they had three eyes if they suggested that. But that's effectively what we're doing with housing. We're relegating every single determinant of housing production cost and housing approvals to localities, and so I think there is a really strong role for states to step up and figure out what they can do to provide some sideboards, some guardrails for localities as far as project approvals and the expenses that are thrust at housing producers in an effort to bring down those costs.
So, a takeaway then, do we see inclusionary zoning as a bad thing ultimately, or how would you rate it at this point?
I'm actually a huge proponent of it, to be honest. I mean, I think there's a lot of benefits, social, economic benefits to putting lower income units in a market rate deal. So I'm a developer and I'm supportive of it. Saying that, it can't be put on the project's shoulders. I mean, that's kind of my main point there. So, hey, we're happy to put 60% of median income units into our complexes, whether it's 10% or 20%, heck, 30%, at some level we'll probably push back, but as long as there's proper offsets there, so if a 3-bedroom, 2-bath unit would rent for typically, $2,500 to $3,000 a month, and we can only charge $995 a month, which is what the 60% of median is. Like, there's a delta there each month that's pretty significant, right? That needs to be accounted for, and so hopefully we can get the state to kind of come back around, and the city, of course, because the city's passed their IZ policies, and really look at that and say, gosh, we want more of this in there.
Have you been able to make it work, and if so, how have you been able to make it work?
Yeah, we've got 2 projects. To my knowledge, we're the first 2 to really actually go through the regulatory agreements with the city. We're about 30 days out for permit and about 90 days late for permit as a result. But yeah, the initial regulatory documents they gave us were kind of crazy. We're like, who signed these? And they're like, well, nobody yet. So anyway, we worked through that. We got them to a point where we could live with them. And then fortunately, I give credit to the Housing Bureau, because we just made the point. Mike and Oregon Smart Growth and Up for Growth and myself, my team personally, just said, hey, listen, rather than going through this protracted negotiation every single time and every project getting delayed, why don't you use these as the base templates and then start there? And so they actually agreed to it. So I give them full credit for that. So we're hopefully, knock on wood, we're getting closer on those two. But the way we've made it work is basically using what's called the Novick rule. I don't know how many, this is getting a little granular here, but essentially you had a choice there in that first year of IZ to do 8% of your units at 60% of median income, or to do 15% of your units at 80% of median income. And so you take that 8% and you apply that to the number of units that are in a project. So, if you take 8 times like a 40-unit project, right? So 3.2 units, right? Well, you can actually, because of the Novick rule, do an application to convert that to bedroom count. So because the city wants family housing, they put that rule in when they passed IZ, and so we're able to use that. Actually, that 3-bedroom unit wasn't by accident that I quoted that. Our Multnomah Village second phase actually has one of those units in it. It's a 39 unit, and so we're able to just do one 3-bedroom unit as our qualifier because of being able to do that conversion. And so it works. So it's only impacting one unit across 39 units. It's a family housing unit. So the numbers still worked. Also, I know we're going to get into this question later, but the difference between private equity and institutional equity, probably not a bad time to address that topic. Those projects are both 39 unit, and then our phase 2 on Division is a 54 unit. Both those are smaller mid-sized projects, so I'll call it under 20 million. Those are kind of friends and family investors, and their return requirements aren't the institutional level return requirements. So, they're happy with an 18% internal rate of return, 5% cash on cash year one, whereas an institution, is probably going to need to be a 24, 25% internal rate of return, and we use return on cost in the institutional world, but they're just very prescriptive in how and where they'll put their money out. And right now with inclusionary zoning, it doesn't fit in their box. So so you're going to see some private sector solutions on a smaller scale, even through this cycle, micro units and stuff that, a local developer like myself can pool together some friends and family, go build that 39 unit, that 54 unit, and we're all pretty happy. We're building good product. But it's not going to solve the $155,000 or 155,000 unit deficit that Mike described that we're already facing as a state. You're going to need institutional capital to come into the market and attract that capital. So the numbers are going to have to get better. Again, what's the income? What's the cost? And one of those has got to move to bump up the needle to get it to that level.
And I think you just described the reason why inclusionary housing isn't a silver bullet, why no city across the country has figured out how to, address their housing shortage, their affordable housing shortage through just inclusionary housing. I think the maximum units of affordable that any IZ program has produced around the country, caps out at, 300 units a year. We're not going to solve the housing crisis by knocking off, one-off deals where we have a family unit that's affordable to 60% of AMI and producing, 200 units of affordable a year, not in the crisis that we're experiencing in Oregon. So I think, in my travels around DC and New York and other places with really sophisticated affordable housing financiers and developers, I've learned one thing, and that's that cities go to inclusionary housing oftentimes because there's no other option. There aren't any other tools in the toolbox. So similar to your point on institutional equity, I think what we need are innovation. I think we need innovation in creating new tools in the toolbox, both from a policy standpoint as well as from a private sector finance sector standpoint. Right. So I was just talking to a bank that is developing a mezz loan program that can go on top of conventional financing for inclusionary housing projects that they're financing on the back end with public bonds. We're actually on the Hill right now shopping around a bill that would create a credit-enhanced version of the 80/20 private activity bond program that would actually make inclusionary housing projects work at a scale that could move the needle. And so that's why, you know, we think it's so important to be engaged in DC and not just in our local cities or even in our state houses, because the power of DC to actually appropriate funds and create innovative tools, you know, if successful, you know, that could really assist cities that otherwise, you know, can't get at the outcomes we all want by themselves.
Well, and Jill, you know, actually this morning at NAOP, the developers roundtable, I mean, I think it was it Jill Sherman? I don't know who was there. I think it was Jill Sherman at Girding that either they were putting together a fund or it was questioned whether they were might be putting together a fund of kind of social investing, if you will. So they're willing to take a lesser return in order to provide, you know, to invest in these kind of projects. So I could see that. I mean, the returns that we're delivering on these two inclusionary, they're great. I mean, you know, most people are earning 2%, you know, in a money market, and, you know, unless they're taking the risk of the stock market. So, you know, if you can earn a 5-6% cash on cash return right out of the gate, and, you know, and overall, if we do a good job and we exit right, and maybe it's an 18% IRR, you know, that's a really reasonable return. I think most people are pretty happy with that. And I think I hope we'll start to see some private market funds and institutional level equity kind of come in that way too. So it truly becomes this public-private solution.
Are we seeing, clear other major metropolitan areas that have effectively found that balance and are managing both the private equity and the institutional fund world in a way that is worth noting, or that we can look at and go, hey, somebody's figured it out a little bit better and we ought to try?
No, I mean, there's no city or state that has completely figured this puzzle out. You know, that's you know, your question is what I get asked every time in a congressional office or an office with a senator, you know, asking about how do we really, you know, lead, how do we drive. But I do think we have good best practices. So in the Bay Area, you know, we were talking about major employers earlier. You know, big blue chip companies with low costs of capital are actually stepping up and lending money to cities, believe it or not. You know, private companies lending money to cities that used to work the other way around to address affordable housing. And so I think, you know, that's an approach. I think the other approach that I would just point out are better calibrated inclusionary programs. So I think one of the programs that's interesting to look at is, you know, New York City, where upzoning was tied specifically to, or maybe Seattle's a better local example, but where the upzoning is tied specifically to the set-aside requirement. So there's calibration there. So the policy priority is revenue neutrality from a project underwriting standpoint, so that you can get at, you know, a significant set-aside of affordable units while at the same time not impairing the market to the market's ability to build housing overall. And I think those are some of the practices that we need to pursue.
And Tim asked the question when he was up regarding the opportunity zones. It's probably a good place to address that if you have a perspective on that. I mean, what is the implication likely going to be with that in front of us? Are we going to see a significant impact? We're going to notice it in Portland, or
I don't know. I mean, I would think
Washington?
yes, if we can get a pool of. I mean, what it does do is it opens up the possibilities of maybe non-real estate capital coming into the market. For me, like a good friend of mine just sold a big chunk of his company, and he's trying to figure out, you know, he's like asking me about opportunity funds because he's like, you know, this is like a business sale, like a tech company sale, but he can take that profit and put that into a real estate deal. And he already invests with us on a real estate deal basis anyway, so he's perfectly comfortable. So he's like, I'd much rather take it and put it in an opportunity fund that would do deals that you execute on versus like throwing it in the stock market or parking it in a money market at, you know, 1.5%, 2%. So I think it will drive more potentially, as long as, you know, people are setting them up. I don't know what, you know, we've talked about it a little bit, but I'd be curious to see like how people really grab onto this. But potentially, if they really do, you get a lot of sponsors that create these funds. Yeah, I could see more equity coming into real estate that isn't normally in real estate. That, of course, has its own set of problems, too, because non-real estate people, techie people, don't typically understand real estate, and real estate's kind of a different animal, but we'll set that aside for a later discussion.
There's also a concern around opportunity zone equity going into non-housing and non-real estate assets, right? And so I think there's globally two concerns with how opportunity zones play into the housing market and overall availability and affordability. One is, how much of this is really going to go into housing? So we've been talking to HUD, we've been talking to a number of offices back east. So it's talking about, how do you overlay a housing zone concept on top of the opportunity zone concept so you can ensure that in these disinvested communities that are getting significantly more investment because of the incentives offered in the program, how do you ensure they're also building an adequate amount of housing to match the job creation, the economic opportunities that are created in those places? I think the second the second issue is, how do you prioritize housing in the context of opportunity zones, from a sort of tactical perspective. And there are some ideas around, pairing it with local programs that are state-enabled, perhaps tax abatements, perhaps local opportunity zone matching concepts. So, the rules are being written. The jury's still out, but we'll see how it plays in. But I think we need to be intentional about how do we make sure that we are creating healthy housing ecosystems in these zones where we're trying to, incentivize more capital coming into historically disinvested communities.
Before we move on to other topics, I want to see if there's anyone who has any questions so far about what we've been addressing. Go ahead, Tim.
So we're in a period where we're having a great economy, strong economy, lots of dollars, good money for government. What happens if it turns south, and how does that play into all of the stuff that you're talking about in terms of housing affordability and all of that kind of stuff? You might want to repeat the question.
Yeah.
Sorry.
That's a good question. So the question is, like, what if we head into a recession? Right now the governments have a lot of money, and they aren't going to have as much money, and others aren't going to have as much money. How is that going to impact it, right? That's the primary gist of your question. So, I'm just weighing in my head, because I haven't thought this one through, but there's the benefits, advantages and disadvantages, right, to anything, right? So potentially you're not going to see as much construction, so maybe that cost goes down somewhat. You're going to see maybe not as many people can afford those units, so that could be a downside. I don't know. We still need the housing, right? I think we all experienced in Portland, through the worst recession we've all lived through, Portland was still growing at 20,000+ people a year. So we still need housing is an issue that doesn't go away because of a recession. So, and fortunately the public has spoken. They have, with their dollars, their voting dollar, their vote and their dollars said, we need to solve this problem. So you're seeing this issue in homelessness come out a lot more, and the public sector saying, hey, we need to put money and solve these issues. So fortunately, we have a pretty good war chest from the previous bond measure. Now we've got an even bigger war chest with this one. I think a real determinant will be how we choose to deal with the constitutional amendment change, which I think is a major positive. How do we set up a way to leverage, whether it's an opportunity fund, whether it's private investment dollars, whether it's institutional equity, and leverage that to create more velocity in the low-income housing through public-private partnerships? Because we all know that the private sector can deliver units a lot more efficiently, a lot less expensively, right? Which is a good thing. We don't want that abused, but I think there's a real opportunity here to really lever those dollars and make, really continue to make a dent even through the bad times, to your original question.
Yeah, and I would just react to that by saying, having lived through 2008, as I know many of the people in this room lived through as well, this recession, our next recession, is not going to be a housing sort of finance-driven recession. It's likely to come from some other corner of the market, which I think is a really interesting question, when thinking about sort of the dynamics of, look, we're already in a housing shortage in the state of Oregon. If we have economic, fallout, we go in a softer period, how are you going to underwrite, Tim, how are you going to underwrite a new project to build, right? So the shortage and its negative implications could actually get worse. I think from a policy perspective, we need to start talking about housing production and policies that make it cheaper, more predictable, and easier to build needed housing as an economic development issue. And I think there's a really strong narrative to have a conversation around. By enacting these sorts of policies, we could actually smooth out a future recession if we're able to time it right and able to enable the private sector and the public sector to come together, not only build needed housing, but create the hundreds of thousands of jobs that we could create in the construction sector, create the GDP that we could create nationwide, by being really intentional about resolving this severe underproduction of housing.
Yeah, and I think to dovetail off of that, I mean, the city or the state could step in and say, hey, we're going to buy this project from you for X price, right? That guarantees a certain profit, or we'll guarantee a certain rent level for that unit so that production can continue. So that answers the question of how do you pro forma it? Well, it's easy to pro forma if there's an exit already built in, right? So, I mean, there's going to be we don't want all the projects to be that way necessarily, but we certainly would be open to doing some projects that way where there's kind of a built-in exit or a built-in stabilization that's enhanced by the cities or the states, as part of this public-private partnership and both the bond measure as well as the other tools in their toolbox, property tax abatements and SDC waivers. And so again, it's, hitting kind of either the cost side or the income side.
Yes, sir, go ahead.
It's slow to happen. I guess they get it. They're smart people, but there's this political side and there's this practical side, right? And a lot of times I think our politicians the voice on the political side can be a lot louder, right? And so, I mean, I sat down with Nick Fish when they were getting ready to pass IZ. I just said, here's what's going to happen, and here's why it's going to happen, and you understand. And he gets it. He's a smart guy. There's political realities, and he looked at me and said, it's going to pass. So, I mean, this is what's going to happen, and then we'll have to monitor it and adjust it as needed. And he made the promise that he would measure it, and he has, although I think somebody else took over the driver's wheel on this 18-month report that came out from the Housing Bureau. They're saying like 2,000 units in IZ. I'm just like, no, not from the private sector anyway. I mean, I think they're counting all the units between the public side, the project side, and the IZ side. I think if you look at the private side, in fact, I would be willing to buy somebody dinner that went onto their map and actually counted like how many, because they have a little map and you have to click on the individual icons and it'll tell you the project and how many units in that project, and there's like 120 of them on the map or something. But if you went in there and added up the units that are actually private sector deals that came in after IZ, so you'd have to look at the date too, but I know that number is like 300 to 400 units. Again, kind of to your original question though, I mean, I think, I don't know. I mean, I just hope they get it. I mean, we've got a whole new, as you know, people coming in, and we've got Joanne just got voted in, and I don't know Joanne that well. I don't know how, she seems like a smart gal. I'd met her once, but I don't know how she'll react. I mean, I know she's going to be pretty fierce on the tenant advocate side, but also she seems pretty sharp on the business side. So, we could be pleasantly surprised too. I mean, I'm holding out hope. I'm a developer. I'm positive. What can I say? Yeah, so, I mean, to your point, how, 17% seems like a pretty good IRR. I would agree. I mean, most people in the stock market are hoping for 12 to 14, right? I mean, or beating 14, I guess. But, that's if everything goes right, obviously. And so it's only as good, the IRR is only as good as who underwrote it and who executes on it. So not all 17 IRRs are created equal, I would say. I mean, I like to say we under promise, over deliver. That's just our kind of mantra in-house. But, and we execute, we like to think we execute well with the help of our team at Perkins and many others that help us, because we need all the help we can get. But yeah, I mean, I think there's a lot, but to your point, I think there's a lot of people that would say a 17 IRR is phenomenal.
But I would just sort of, going back to your original question on the politics of SDC fees and the politics of, linkage fees or inclusionary housing, or you name, the fee or requirement. And I think that we need to, as the business community and as the real estate sector, really focus on changing the narrative and creating the space where elected officials don't face that political calculus. And the question that they face is, how do we promote housing, as opposed to how do we exact concessions and money from money grubbing developers who are building housing. And we've had some success with that. We've seen the narrative change, particularly at the federal level over the past 12 months. And I would also say that I've been very encouraged to hear Speaker Kotek and others in the legislature talk about this imperative to make housing not only more predictable, but also cheaper to produce, to benefit broader affordability. So I think we're heading in the right direction. There's a lot more work to do, but I think that's got to be the priority to address the SDC sort of cognitive disconnect that you described.
Yeah, and I would add to that too. I mean, what you buy into when you buy into a project like with us, for instance, when people invest with us is, hey, we're going to get 5% return, right? Cash on cash return, which is enough to make the deal debt service and create a nice little cash flow to begin with. And then assuming the market continues to rise and rents go up over time, we see appreciation. Hopefully we're building for less than the market's selling for. That may not be the case in a declining or a inclining cap rate environment, declining value market, right? So, that was another example I've used with our elected officials is like, hey, we're kind of the cowboys out there, signing on loans, building these things, taking risks, digging dirt, and we're doing it for a 5% return basically, and then if everything goes right, it's maybe 17. Right, and I'm like, I'm looking at Nick, and I'm like, so by the way, what do you get guaranteed from PERS? And he knew the answer. It's like, he gets guaranteed 8%. I'm like, so I'm getting 3% less than you, and I'm signing my balance sheet, my family, my house, and so to Mike's point, I think I think that hits home when they're actually able to sit eyeball to eyeball with somebody like myself or any of my co-developers, developers out there. It's just like, guys, you got to realize what we're doing here, and it's we do it because we love it, and we do it because we really truly have a passion for what we do, but we're taking risks.
So are there what type of epiphany or rewards can you put out there to incent or create clarity from a political standpoint? I mean, what carrot do we have out there? What incentivizes them to do it aside from they're going to get voted out if they don't do X? But that's so vague and nebulous anyway, right? So are there some incentives and carrots that we can put in front of politicians?
Let's make them invest in the projects. Sign on the ballot, sign on the loan with us, right? Or maybe they are the loan. That might change their mind a little bit. They start seeing the environmental stuff creep up and like little problems. They're getting the little quarterly reports. It's like, oh, we ran into fuel in the soil. It's going to cost us $50,000. What? That's not guaranteed.
I would also add just from a political standpoint, we've got to recognize that there is a short-term crisis, and simply building more housing isn't going to address the short-term pain that 11 million renter households across the country are experiencing, where they're paying more than 50% of their gross paycheck on rent. 25% of Oregonian renters are in that situation. So, not only do we want to sort of speak rationality to policymakers who are enacting these fees, but we've got to give them another option. That's better than just, charging another development $5,000 a door.
I just thought of something that just came. So, one of the huge problems, of course, is income inequality, and you have already made those arguments. I don't know. But,
Yeah, no, I agree. We were talking about infrastructure earlier. Pre-World War II, when we were building out major American population centers, it wasn't development that was shouldering the burden of the infrastructure needed to support it. It was the federal government building roads and highways and all of that infrastructure. And so I think there is a rethinking that needs to happen at that level, and a move away from that user fee model.
I also think they'll get desperate enough if there's not housing. I mean, I don't want us to get in that position. None of us do. But I mean, I was down in Florence earlier this year, and they're just starving for units down there. I mean, and they are very progressive. I mean, they're like, we've got money, we've got land. You know, I mean, they've literally lost companies moving to Florence that they've, you know, wanted to come there because they don't have the housing. And they've done their 20-year housing plan. They know how many units they need. They don't have a single commercial general contractor down there. They don't have a single commercial developer down there. So the whole reason I was brought down was to just sit down with them and the governor's office and the city planners and managers and the mayor and just like, hey, what is it going to take? And it's going to take, you know, the whole village, you know, and everything else, because they've got a whole nother problem. Like, how do you build units at the coast when you don't even have a general contractor that, you know, can build that capacity, right? So modular, some ideas that got thrown out. I mean, they've got, I mean, just to build their new city hall they just built, they had to bring a contractor down, house them down there in like a hotel, and then these people would commute down and to build, and it cost them like $500 a foot to build down there. I mean, because they're building to coastal standards, they're building to government standards, and they're having to import the human, you know, capital to get the job done. But they're desperate. I mean, they really get it. So I think at some level that will happen. I mean, I hope we don't get to that point. So if anybody wants to go get a job, like go build units in Florence, because they will roll the red carpet out. They will do anything they can to make it happen. So.
I really think we need to improve our lobbying efforts. I mean, I'm convinced we need to get a concerted effort to lobby these people and get in front of them. It takes dollars.
I'll use this as my sales pitch then for Oregon Smart Growth because I'm on the executive board. We formed Oregon Smart Growth in summer of 17.
Summer of 17.
Summer of 17, as IZ was.
Summer of 16.
Summer of 16, before IZ was going to pass. And it was a group of us developers, and we pooled money, we got a lobbyist, and we took the approach, we're going to collaborate with the city as opposed to beating them over the head, tell them everything to do wrong. We're like, we're going to go and just show them the numbers, we're going to educate them, right? And so that organization has grown. We're still trying. I mean, we're in an infancy, but we have that lobby effort going. We've got Gwen Baldwin, who's down at the state level, very connected, along with Danelle of the Romaine Group. And then up here locally, we're going to be hiring a local advocate, soon to be announced, and really trying to, because 19 is so critical, as you know, and it takes, and it shouldn't just be lobbyists, right? It should be. I think it has more impact when folks, you know, that are. They're voters, right, to your point, not necessarily the lobbyists that are walking in their office and setting appointments and saying, or going to a meeting and saying, hey, here's my idea. Here's what we need to do. Here's what's not working. Here's what you need to be listening to, right? So, but we have to get involved. And
Other questions? Yes, sir.
So Jill Sherman brought up to meet the affordability issue.
Yeah.
You want to repeat?
The question is sort of, you know, innovation, whether it's construction or capital, and how do we sort of achieve affordability and meeting the need, and is the public sector open to the sorts?
They're not coming down.
Agreed.
To solve that problem.
Yeah, and I think, you know, here in the city of Portland, there's two projects going on right now. There's the residential infill project, which seeks to enable what I would call innovative product types, but really it's back to the future. You know, we're talking about, you know, row houses and duplexes and triplexes being built in, you know, Portland's residential established high opportunity single family neighborhoods by, you know, mom and pop, entrepreneurial, you know, homeowners or people, you know, wanting to take advantage of that. And so I think that's one area where the city of Portland is not only open to it, but they're championing a pretty revolutionary code revision that would enable more general density in established Portland neighborhoods. And I think, you know, along the same lines, you know, better housing by design is, you know, maybe the old name of the project. I'm not completely current, but there's a project to focus on Portland's multi-dwelling zones, not the high density mixed use corridors or urban core of the city, but to enable, you know, more dense, more compact product types. But I think a lot of the innovation, frankly, has got to be sort of championed by the lending sector. I mean, Tim, I don't know what your experience on this is, but to me, my perception is that the public sector has been a lot more forward-thinking and open to reducing parking minimums relative to lenders or equity partners' requirements on the same. So I think that to the degree that we want to scale up some of these innovative construction approaches or innovative product types, we've also got to convince capital to step up and start underwriting those sorts of projects.
Yeah, I mean, we've looked into modular, different types, different manufacturers. What we found is that there isn't a cost saving there, right? So it will save a little bit of time, but it's not really outweighing that cost enough to make it worthwhile, and the inflexibility of it. So at least in the urban side, we haven't really explored it out in the like the garden style yet. But I think it's safe to say that at least from my few experiences in really rolling up my sleeves and getting dirty in that and looking at it a little closer, it just wasn't a savings that was there, unfortunately. So I think. But I do think, to your point about like co-housing, we've looked at doing modular unit or, like where you've got shared bathrooms, shared kitchens, things like this. Micro units, you're seeing a lot of those getting built. I think those are great. I mean, I think the city needs that kind of thing. And I think I think people are more than willing to live in those situations and really enjoy them, actually, because it's really about community there, right? So you do reduce cost of construction because you're not building as many bathrooms, you're not building as many kitchens, so I think there are some creative ways, and I think you'll see the private sector, you're already seeing the private sector figure that out, in fact, start to ferret that out and deploy it successfully. I mean, you had the Arthur down here, right in downtown that was an old SRO. I mean, I remember that deal, one of the guys in my old Marks Millichap office selling like back in, I'm dating my 97, I think it was, but, and then it changed hands, and eventually the guys that took it over had the Pacific College of Art, and then now it just traded for a huge number. It was like a 4.5 cap deal. It was an old SRO deal. And actually, my director of development, Kevin, had lived there when he was doing the MRAD program for a short period of time. It was like, people were more than happy to move there. And, it was like less than $1,000 a month. Now it's a postage stamp size unit, right? But I think those kind of things will be coming along. And, I haven't run one through. I know there are lending sources for it. You could probably answer that better than me, if you guys would lend on that. Daniel's with Washington Federal, by the way.
We just closed on a partial SRO project.
We just have a couple minutes here. Any more questions? Any more questions? Okay, so I'm going to give you two gentlemen the final remarks then to take this conversation in whatever way you feel is at least wraps it into a little bit of a bow or opens it up enough so that people leave here going, okay, I have at least a sense of perspective about the complexity of this and maybe where Tim's attitude and mind is about it and Mike's attitude about it all.
I'm the opposite of complexity, right? Kind of back to my Joe Weston statement there. I mean, cost, income, right? If I can get nothing else across, cost and revenue, let's put it that way. So, I mean, I think there's that, but I think most importantly is to communicate with our politicians, to make sure they hear from us, that they are doing smart things. I mean, you've seen these neighborhoods kind of rise up and change their own destiny, right? We as a city need to, if we want to see change, we have to be that change, right? We can't just sit back and somebody else is going to go hire the lobbyist and do this and it'll get done. That's just not how the life works. So roll up your sleeves, go in there, make your voice heard.
Yeah, I agree with Tim, and I would just say, our organization starts with a vision that communities should grow for the benefit of every person. And right now, Portland is not on the track of growing for the benefit of every person. And I'll break it down real simple as well, as build more housing, meet the need, meet the demand created by the new jobs and the population influx coming in year after year. And so, to your point, if you're not at the table, you're you're on the menu. And I think that over the past couple of years, the Portland, particularly the urban, development community working in city of Portland, like Tim and many of the folks on the Oregon Smart Growth Group, have realized they've gotten engaged. They're having productive dialogue. I think we need to continue that and really, change the narrative and really pursue solution-oriented policies. Otherwise, we're at risk of becoming the next San Francisco.
That's a daunting thought, isn't it? Way to finish on that. So, folks, we appreciate all of you being here. How about a hand for Tim O'Brien and Mike Kinsella? Really, really terribly enlightening. I know we just touched the tip of the iceberg, but you helped melt it a little bit, and we greatly appreciate that. And somewhere we have a party gift and a thank you gift for you, and encourage everyone to stay around afterwards. You gents are going to be able to stay for a few minutes, answer questions, and I know Tim and his team, Kimberly and others, Trina will be here as well if you have any questions from a tax standpoint. So thank you all very much. We hope this was beneficial. We'll be doing it again next year, and we encourage you just to let us know if you have topics you would like us to cover. So thank you all, and have a great Thanksgiving next week, everyone.